So in this case, they feel that the transparency wasn't really there. The bank is arguing this, and that their collateral things were being done with with their asset. You know, like we got these little financial babies that we dropped off, and you're not protecting our babies. You know, you promised us this collateral. The collateral was connected to our little financial babies, and you're kind of messing us up. You're exposing us to risk that we did not sign up for. Like just like in a marriage, anybody ever see somebody get a divorce and they say, I didn't sign up for this, right? So the same thing is happening there, right? Because when you make this covenant, it's an economic marriage. You know, you're making vows, you're making promises. You know, I promise, you know, to protect your collateral. I promise to make sure that I don't spend your money on anything that you didn't tell me I could spend money on. I promise that I'm going to maintain a valuation of my company at a certain level. I think there was something in there that I saw about the company maintaining a value above 100 million, which is interesting, right? Because at that point you get into figuring out how you what method you use to actually value the company, right? Like I don't know if they're publicly traded. I didn't know. I don't think they're publicly traded. Maybe they are, and that's easy, right? You just add up the number of shares of stock and the price per share. But if they're not publicly traded, then you got a whole mess in terms of figuring out what the true value of the company is, right?